the health of the commercial property sector under review, let's distinguish between retail, office and industrial, because there seems to be different levels of activity that's coming through there. Starting off with residential development. From all the construction commentary we're hearing out there, it seems that this is a segment that's still under pressure. Absolutely so. I think it is still under pressure. We certainly have come off a period of sustained growth starting in the early to mid 2000s, which perpetuated right through to 2008. So if you look at where we were in 2009, there was significant, I would suggest, oversupply in that market, with liquidity constraints that then followed it and capital contraction. Ability of end user owners to secure end user finance was also adversely impacted, as a result of which a lot of developments couldn't ultimately give effect to their pre-sale conditions in terms of their funding arrangements, as a result of which then excess stock became quite readily available in the market, and that's still, I think we still sit in that situation. A lot of that has been taken up, given the fact that in 2010 we saw significantly less developments brought to market, significantly fewer plans approved. But as we stand right now, I think it's still an area that has some way to go before we are. Of course, we're looking at factors that sit on the one end of the scale here. On the other, we've got low interest rates still prevailing, looking to be here for quite some time, and that allowing for easier access to credit. So how are how's that counterforce coming into play at this stage? I think it is starting to manifest. Certainly, access to credit is a little easier than it was previously. But again, the counter to that, I suppose, would be that household debt to disposable income still remains concerningly high. We're in the upper 70s, and as such, I think the consumer is still under pressure. And I think perhaps a degree of prudence is in the market, in the end user market as well, that wouldn't have been there 2 or 3 years ago. So people are treading a lot more carefully as well. Even if that broader macroeconomic picture wasn't shifting, you've highlighted that household debt to disposable income still remains worryingly high. Just how much risk does that bring to to further investment within the sector moving forward and supply coming back on stream? Well, I think, as I say, the broader industry is a lot more prudent. And when I say the broader industry, I would include developers, investment financiers, and the ultimate end user home loan owners. So that level of prudence is certainly more paramount than it would have been 2 or 3 years ago. And as such, I think we are at a period where we expect to start seeing evidence of uptick in activity, and certainly I would say a large percentage of that oversupply having been mopped up towards the end of this year. Yeah. But I think going forward, whatever growth takes place will be on a far more muted basis and far more realistic, quite honestly. Let's move on to office space. Absa highlighting that the demand is node specific. So where are you actually seeing that demand starting to pick up? Because forecasts are that vacancies will be reduced to below 10%. Yes, I think a number of the decentralized nodes are showing uptick in activity. I would certainly suggest that on the Durban La Lucia Ridge node, we're still seeing active new developments coming to market, again in response to demand. And I think that's the key differential, is that this is generally tenant driven, and this as opposed to sort of more aggressive speculative or quasi-speculative positions being taken. In other words, really where the activity is happening is where it's in response to a long-term lease with a sustainable cash flow. Generally speaking, across the decentralized office nodes of the various major metropoles, we're looking at vacancies of between 8 to 10%, and that's effectively stabilized. We expect to see that start coming off as well. CBDs, perhaps a wider range from below 5% vacancies in Pretoria to in excess of 20% in Durban. So that's, and again, if you look to the demand on the Lucia Ridge in Durban, perhaps there's a correlation between the vacancy factor and the Durban CBD. With that being the case, office buildings completed in 2010 were down 40% on those built in 2009. With that being the case and growth slowly starting to pick up, do you foresee an insufficient supply line filtering through within that office arena? Possibly, yeah, I would say. And I ask because that would then have an impact on pricing and then more importantly, building activity picking up moving forward. Yeah, I think, that's looking perhaps towards the latter part of next year where we may see that. But if that is the case, I think what you're finding is you're finding far more, a lot of conversion of existing office space. So within the existing space, I think you find a lot of consolidation of companies sort of consolidating their premises, and then also effectively reconfiguration of existing space. So sort of B and C grade space being converted to A grade space.
and as such meeting the needs of the tenant from within the space that it's occupying, as opposed to necessarily requiring additional stock coming to market.
Mike, very quickly, within the industrial space, the manufacturing sector has been amongst the hardest hit, you know, in that economic downturn. Just how hit is the question, and what kind of impact has that had on the industrial outlet space or building space specifically?
Yeah, I think it has. I think it's had a significant impact. I suppose two of the major factors were the downturn in global demand, and then coupled with that was the strengthening rand, which obviously had a massive impact on exports. And as such, the manufacturing sector was adversely affected. I think the infrastructure spend leading up to the 2010 World Cup perhaps buffered that to an extent where the sort of fallout was not as severe as it might otherwise have been. Where we stand now, I think the recent Purchasing Managers Index is ticking up nicely. I think the February data was the highest it's been in the last 10 months. So it suggests there are signs of renewed activity there. So I think it was more adversely affected than the other sectors, but perhaps best positioned now for greater level of recovery.
Well, Mike, thanks so much for having joined us this afternoon.